Hey guys, and welcome back to the channel. It's me, Adam, and you're watching Unlimited Options Investing. No surprise to anyone, the last week in the market was a bloodbath. Whether you were in the stock market or the crypto market, it's all going down. Anything risk on or high growth over the upcoming few years is just getting decimated in the short term. So what I ended up doing this past Friday was I sold some of the fat out of my portfolio, some trades that didn't go so well or things that I didn't have as high conviction. It's not as simple as just selling as things are going down, but more so having that cash available for bigger opportunities, as a lot of the higher quality names are also on sale. Companies with higher margins, with high profitability right now versus the zero revenue, or companies that have a lot of potential in the long term, but right now they're not doing very well. The market isn't showing any love for those kind of stocks. So in this video, what I want to talk about is, if you are buying the dip, do you want to be buying shares or do you want to focus more on LEAPS, long-term dated options? Because what you might be thinking is, oh, because everything's going down, it's a good opportunity to buy either or. But actually, when it comes to options, there are two things that make up the premium: the intrinsic and the extrinsic value. So the intrinsic is simply the underlying share price. So if the stock is going up, the intrinsic will go up and vice versa. The second thing, the extrinsic value, comes from two things. Number one is how volatile the underlying stock is. The more volatile, the more you're going to be paying in extrinsic value. The second thing is how much time value is left up until expiration. If there's only 1 week, there's not going to be that much extrinsic value. But if you have 6 months, a year, 2 years, you're going to have to pay much more in value. So we're going to get right into the video. If this is your first time watching the channel, welcome aboard. Hit that subscribe button. Here at Unlimited Options Investing, we talk everything from stocks, crypto, options, ETFs, and we're investing for the long term. As always, we're going to be smashing that like button. Let's get started. All right, so taking a look at the candlesticks, and we're going to be looking at the stocks that I mentioned in my stocks to buy for December of 2021. The first one being Facebook stock. And the first thing I want to mention when it comes to the stock is, whenever it would reach the 200 simple moving day average earlier this year, it often found buying pressure at these levels. So we see a low of 244, and this was around the time that the whole Signal, WhatsApp, all that fear was coming into the market. Everyone said, oh, no one's going to use Facebook again. Obviously, that wasn't the case. So we found that buying pressure once, we found it twice, and we actually found it once more again about a month ago at the end of October, and then we found buying pressure, we went back up, and now we've actually gone back down below that. So that's just something to take into consideration, that if we do continue going lower, then we really are going to be disconnected from that 200 simple moving day average, but perhaps we're just going below it for a little bit, and then we're going to find that buying pressure once again. But what I want to pay attention to is this IV rank, which is something that I've been adding to my charts, again, because when I'm buying options, I want that to be as low as possible. But right now we're pretty much at as high as we've been all year. For most of November, we were hovering around that 30 mark, and actually during August, we were below 10 for quite a bit. So ideally, what we want to see in these prices, that if we do want to pick up LEAPS options when the price is low, when the intrinsic value is low, we also want to keep the extrinsic value low as well. Ideally, if you want to get into LEAPS options, that the price stays depressed for a while, it consolidates at these low levels, and then eventually goes higher from there. Of course, you can't time the exact bottom, but any kind of consolidation will lower the IV, or the implied volatility, meaning your premium will also be lower as well. One Facebook option I'm taking a look at for the future, and when we go to options over here, January 2023, is the $300 strike. Right now we can see that we're trading as low as we have for most of this year. But one thing to pay attention, and why you should always reference to the actual stock chart, is because back in April and May, this January 2023 call had a lot more time value or extrinsic value than it does right now. Because when we take a look at the stock price from back around that time, because sometimes what you'll notice is that the price doesn't align with the current price, even though the option price is similar. In this case, it's kind of the same, but it's something you always want to take into consideration. Always refer the option chart to the stock chart, because oftentimes there is a disconnect between the extrinsic value of the option, whereas a regular stock chart doesn't show you any extrinsic value, purely what the price is. But let's take a look, for example, at JPM stock. For this one over here, the IV here is much higher than it's been all year. JPM is a value stock similar to Berkshire. Usually the volatility swings aren't too bad with value stocks, but I guess just in the past week, the market has been very shaky, as we can see with the IV rank being so much higher than it usually is. Usually it's like, what, below 10? We had a spike in September and October when we had some volatility in the markets, but then it quieted back down below 10. And then now we're way well above that at about 80. So definitely not the best time, in my opinion, to be buying JPM LEAPS. But I am a fan of the stock. Shares would be a pretty good idea at this point until you get some kind of consolidation or the IV goes lower. And similarly, another value stock is Berkshire Hathaway. This one as well, where we see the IV spiking massively because of such a sudden drop in the market, where we usually see the stock on average, let's say around the 20 or the 30 mark. Right now we are at 94. So although I like Berkshire as a company, I think it's a great value stock. It's hard to go wrong with such a conglomerate in the long term. Right now may not be the absolute best time to be buying options, or because you are paying a lot more for that extrinsic value. Similarly, if you take a look at Visa, same kind of idea as well. Anything financial really is so much higher than it has been in recent history because the volatility has just been so turbulent. And same thing with MasterCard, you see it much, much higher than it has been in recent history. Let's take a look at PayPal. This stock has been absolutely gotten beaten down, and we see right before the earnings call, right before it dropped, so usually when IV is the highest right before the earnings call, and then right after it drops like a rock. And we see that very clearly over here, but then again, as the stock has been very volatile itself, it's gone right back up to about earnings levels. And it has been consolidating for a few days, and yet it still is high. So something to keep an eye on is the IV rank. Whenever you want to buy options, you want that to be as low as possible. Another financial processor, Square. This one, if you look at it, same kind of idea. Right before that earnings call, it spiked up. Right after it, the IV melted away. But over the last week or two, we were well above $200 a share. Right now, we're trading at 181 with a low of 174. Although on the daily we are oversold, our IV is as high as it's been pretty much for most of the year. So maybe this is the kind of thing where you want to dip into shares first until IV does go down, and then maybe gradually turning them into LEAPS options. But then maybe at that point, maybe the intrinsic goes up much higher and then you'll be paying much more. So it is a balancing act. It isn't the most straightforward of processes. You do have to weigh your options, and you do have to take risk of some sort, whether it's now or later. It's a risk if you do it now, it's a risk if you do it later. No one knows. You just have to do what fits for your portfolio, what fits for your circumstances, and then go from there. And that's all, folks. Thank you very much for watching the video. Let me know in the comments below. Are you buying shares right now? LEAPS? Are you sitting on your hands? Are you not even touching the stock market? Are you waiting for a bigger dip to occur? Let me know in the comments below. As always, subscribe, hit that like button, and I'll see you in tomorrow's video.